Initially, the economic impact of the coronavirus was thought to be rather mild. However, after careful observation over the past couple of weeks, it now seems the impact will be rather severe. Airlines have been shutting down routes, travel is being restricted, companies all over the world are telling employees to work from home, international events are being cancelled, schools, theaters, and entire cities in some cases are shutting down in many parts of the world. In fact, my friends in New York City tell me now you can get a seat at the most exclusive restaurant. According to several reports, the Chinese economy will shrink to the tune of 20% on a yearly basis since the beginning of the coronavirus. If this is confirmed, this means that the best we can expect from China for 2020 is zero growth. In fact, Chinese car sales for February were reported 80% down. This is the lowest figure on record. And while the US does not seem to be impacted yet, Europe's economy, which was already flirting with recession, is now almost guaranteed to enter recession. Italy, which has a weight of 50% in Eurozone GDP, is currently in panic mode, with tourism down severely and many cities in lockdown. On a positive note, however, and we will discuss why it's positive in a future video, the off-risk environment is pushing the dollar down across the board, especially versus the euro. As we had discussed in the previous video, the euro has been used as a funding currency for a while now. So if many of these carry trades unwind, the euro should appreciate from current levels. Please note that fair value for the euro versus the dollar, depending of course on the models used, could be a lot higher from current levels. For example, 2019 OECD data suggests that on a PPP basis, the euro should be at about 1.38 with the dollar. So investors who regularly trade in Forex have to be very careful and not to be complacent with the dollar's strength all these years. On a fundamental basis, it's important to keep in mind that the euro could go a lot higher. As far as our investment strategy, we were about 70% cash going into this crisis. We have since deployed some capital, however, we are still over 50% on the sidelines. We continue to be very, very cautious of the current environment, holding on to our dry powder for opportunities that will emerge from the current turmoil. Please note that opportunities will emerge and valuations will go down. So just be patient. There's no rush to do anything at the moment. That's all for Market Brief. Thank you very much.